So talking about Europe, I mean, the popular, well, there's some narrative has built around maybe this is the year that Europe catches up with the US gains, but I guess that would be to discredit the extent of the gains we've already seen in Europe.
Yeah, no, exactly. I think, look, we're up 25% in Europe. That's a strong return. But I think the real narrative here is Europe fundamentally has lacked the same growth technology engine that we've seen in the US. And as a result, I think most of the US domestic investors have stayed actually within the US and have played those number of Silicon Valley opportunities relative to coming here to Europe.
And so the technology story in Europe then just not developed enough, not exciting enough, because of course we have chip companies aplenty in Europe and exposure in that regard, but not, it's not Silicon Valley.
I think investors have shown clear appetite for European technology. I mean, at UBS we IPO'd Avast, we IPO'd Software One and got a fantastic response to both of those stories. So I think it's really been more a selective supply to a market that actually has quite strong underpinnings of demand here in Europe.
And so without that sort of strong technology pull, can the European equity markets play catch-up in 2020?
Look, there's been a long-running value case for Europe relative to the US, so on a pure valuation basis. The issue has been we've not really seen anything more than tactical short-term moves, more positioning-driven from US investors looking to capture that valuation rather than a really more strategic reinvestment into Europe. So I think if we look forward, particularly where the US market is now, there are some signs that Europe actually could be a lot more investable now than it has been over the previous years.
And one of the things that always seems to weigh on Europe is the troubles in the banking sector and the weak valuations there. I mean, you point out in your notes that European banks hit 20-year lows over the summer. Global banks actually at the bottom two-thirds of sectors year to date in absolute returns. So it's not as if global banks have done so much better, but they have done better than Europe.
I think that's right. I think, look, what people are crying out for in Europe is consolidation. Whenever we've had sort of signs that might be happening, you've seen real interest in European banks. And I think actually over the last 3 months or so, the value momentum trade had really got overstretched, and some more of a tactical perspective, we've seen value being bought, and I think banks represent value. So we've actually seen a pretty good rally in the last few weeks. But again, to turn that from something more tactical to strategic, I think it really needs more of an equity story. And I think that's consolidation really underpinning that.
And does that have to be cross-border consolidation? Because that's where things seem to get difficult.
Agreed. I think that's been the biggest challenge, particularly within Europe, that even within the European Union, it's been hard to do that cross-border. So I think it doesn't have to be. There's still enough individual banks in the respective countries. But I think for a genuine strategic change, we would like to see that cross-border.
Yeah, I mean, such is the extent of overbanking in some markets. I mean, Germany, we've talked about this for decades, it seems, that maybe there are sufficient M&A opportunities to provide short-term catalysts, just keeping it very domestic, are there?
I think that's exactly right. And really, it's about addressing the cost base in a more challenged or slower macro environment where the top line is harder to achieve. It's really about how do you get synergies, how do you take out cost.